All right, everyone, welcome back for the episode of Carnivore Trades. This video is for June 9th, 2024. If you've not done so already, like the content, give the video a thumbs up, like, comment, subscribe to the channel, and come find me on carnivoretrades.com for swing trading alerts, analysis, and live day trading. Now, if you've know my setup here, you're saying, why is Aaron starting on TradingView here? Well, I'm doing a special video here today, and I'm going to do some comparisons, and I think TradingView is a little bit easier to use for those comparisons than Thinkorswim. So what am I doing the video on? Long-term oil exposure. How can we get that? What is a creative way to do that? And it's something that I kind of recently came across and kind of discovered on accident. But one of the questions that gets brought up a lot is, how can you get exposure to oil prices long term? Now, obviously, oil is still a commodity. Even when it goes into bull markets, you get these big mean reversions. But for instance, late 2020, if you, had the foresight to see, hey, the next 12 to 18 months are going to be bullish, how do you get exposure to that without having the contango decay, right? So USO, if you're not familiar, is really a horrible ETF for tracking the price of oil over the long term. It has a ton of decay in those contango contracts. These energy ETFs, UNG is very much the same with the nat gas space, even worse actually. But you can see here, USO, since there's 2008, and we just look at a chart of US WTI, night and day. Obviously, you still have a peak here, but the difference is night and day in terms of actual performance. So, these ETFs, these futures contracts ETFs, not the spot ETFs, have a ton of decay every time there is a contract gap, which is pretty much every month. And it causes the value to go down over time. So they're not good for anything really other than short, maybe medium term investment vehicles. In fact, even if you bought, this is a pretty big bull run, even if you bought USO here at the low, we can go to regular, there you go. You can say, let's say you got in at 20 and you sold at 90. That's like a 4.5 appreciation or X there. But, saying you got in around the same time on oil futures at 10 bucks, that's 13X. So substantial difference. Even with that big bull run, that's how much decay is in USO versus crude futures. And then you might say, well, why not just buy crude futures? A lot of people don't have access to futures, or they're not comfortable trading, so a lot of leverage. Plus, even if you did get in here, if you bought the front month, you had to roll it about 12 times, right? And that costs money. Or even if you buy the back contract, a lot of that premium is already kind of baked into the curve in those situations, so you are paying up a little bit. But what's a good way to get exposure? It doesn't seem like there's a good way to get exposure. There's a few, gold obviously has GLD, tracks the price very well. SLV, of course, and then you have Sprott, tracks the price very well. It's a good spot ETF. But it's funny, right? You'd think that oil and natural gas would have spot ETFs. If either of those things disappeared tomorrow, the world would stop spinning, right? But we've got 7 or 8 Bitcoin ETFs right now, and you could argue we don't need them. But obviously they're nice for trading, but you'd think that oil would have a better a vehicle for that for a retail investor or somebody who's not comfortable with futures. But we're going to look at UGA. And it's a little bit, like I said, it's a little creative here. It's thinking outside the box. But if you just look at a price of oil, right, and we just add gasoline futures for comparison. And now we're going to go as percentage here because it's going to, there we go. So they're about the same, historically. There's a few spikes here and there where, one outperforms the other, but price-wise, it's tracked pretty tightly. Now, UGA is very much like USO. I'm going to put USO on there. You can see the comparison since its inception. Very poor returns versus both. Now, you say, well, UGA is a futures-based ETF. It does have that contango spread, but the decay is really non-existent. In fact, if we throw that on, so the orange line now is UGA, and we go back to the inception, not only is it outperforming the price of oil, it's outperforming gasoline futures. And this is something I came across a few weeks ago, and it's actually very surprising here. So you're going to see 28% since its inception. RB futures down about 12 cents since UGA's inception, and crude down about 17%. USO, just a complete tank. We can actually just get rid of that. So, if you're looking for long-term exposure, I'd say UGA is something that probably doesn't get a lot of love and is worth a look. Now, I noticed that in the short term, it tends to underperform in volatility. So it's not something I would look at for short-term gains. In fact, I would just look at an SCO to short, or a UCO, which is 2 times long short oil, if you're looking for short-term swings. But if you're looking for something like, hey, like I'm going to hold for the next 6, 12, 18 months, I think UGA is certainly worth a look. And I think it's something that does not really get a lot of attention, and I think it is a viable vehicle to use, as it tracks the price very well. And again, oil and gasoline prices historically track very well as well. So let me know what you guys think. Just want to do a quick video here for you guys. Get a lot of questions about this type of stuff, and I thought this was interesting. Don't forget to leave a like, comment, subscribe to the channel. You guys take care, and I'll see you guys all next week.